Hi there, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for June 14th, 2013. In this week's Market Minutes, I'm going to talk a little bit about low price volatility, what that means, and why price breaks from low volatility are so important to picking hot stocks. A reminder to subscribe to my free weekly newsletter at the address you see on screen, stockscores.com/newsletters.asp. So what is low price volatility breaks? Well, low price volatility means a narrow sideways trading range. Now, when I say narrow, it's all relative. If a stock is trading in a narrow range, you can tell when you look at the chart because it's tight and relatively skinny in terms of its overall height. But it's also important to recognize that low volatility also means sideways trading, which means day after day after day, the price is not really changing a whole lot. You don't have an upward trend, you don't have a downward trend, you're in more or less a sideways trend. Now, what these sideways trading ranges represent is an agreement among buyers and sellers on what the stock or market is worth. It's confidence among the buyers and sellers about the value, fundamental value of the company. Now, these sideways trading ranges are extremely important for predicting market-beating price moves because when you get a break from low volatility, you're really getting a break from a situation where the market, the buyers and sellers, had come to some strong agreement about what the fundamentals of the company were worth. And then, with that break from low volatility, it implies that there is new information that justifies paying a higher price. So here's a chart of a stock that's done quite well recently, and I've highlighted with the blue arrows days when the stock broke from sideways low volatility trading. Now I've drawn a green line across the bottoms and a red line across the tops, and the fact that those lines are converging toward one another means that volatility is diminishing over time. The range of price movement on the right side of those triangles is very narrow. And then when you get a significant price break from that, an abnormal price move from that low volatility, it implies that some investors, those who follow the company the closest, have got some new information that justifies paying a higher price. And that is why it is so important with the Stockscores approach to look for abnormal activity from low price volatility. All right, let's get into this week's analysis of the important market sector indexes, starting off as we always do with the S&P 500. And notice that we have a line drawn across the tops in the short term, a red line, that is converging down towards the long-term upward trend line. And we are nearing a point where we have some low volatility right at where these trend lines converge towards one another. So for the past 2 or 3 weeks, we've had a downward bias in the market as investors took profits, but we have not had that long-term upward trend line, highlighted here in green, yet broken. So the bulls are still in control in the long term. In the very short term, the bears have been in control, but we're getting to a very critical point where there is some low volatility. We're starting to trade sideways, and if we get a break up through the red line, well, then that long-term upward trend is likely to continue. If instead we get a break down through the green upward trend line, well, then the long-term upward trend is likely broken and we are headed for a sharper correction or at least some sideways trading. So for now, the buyers remain in control of the S&P. It remains a bullish chart, but it is a very critical point for this market as we come to that convergence of volatility. The TSX has been selling off over the last couple of weeks as well, but it has come to support where it is likely to bounce. We had a strong bounce back day on Thursday, primarily motivated by strength in the oil market as issues in Syria heat up, oil prices have risen, and of course, the Canadian market is heavily dependent on oil and gas. The Treasury bond ETF, which represents the government bonds on the 20-year treasuries, has been falling in the last 6 weeks. It is now at support where it is likely to bounce, and so expect that downward trend from the short term in treasuries to at least slow down in the short term, and we may see a bounce back here in treasuries. The US dollar has been falling sharply over the last month. It really is not yet at support, and so I think it can continue to fall. This is a positive for stocks. It is a positive for commodities as it makes those things cheaper, and we should see this trend continue in the near term. Gold, despite the weakness in the US dollar, has failed to rally. You would expect, with weakness in the US dollar, for the price of gold to appreciate, and that hasn't happened. Instead, we have a bearish chart pattern consolidating down towards support on the green line there, and this remains a bearish chart in the long term. In the short term, a neutral chart, because we've been trading sideways for the last 2 months. But if we get a breakdown through support at the green line, well, then gold is likely headed lower. As I said earlier, oil has broken its downward trend line with some strength late this week. That implies that oil prices are headed higher. It's a bit of a tough call here with oil because the rally in oil is largely motivated by political factors, and if those change very quickly, then you get a reversal of trend very quickly. But for now, we have to put I would say, an optimistic bias on an otherwise neutral chart. The VXX has started to rise over the last few weeks. We've got some rising bottoms there. It's showing that fear is starting to increase. Still not a bullish chart on fear, and so I don't think we should get too optimistic that fear is increasing and therefore we're going to get a correction. But for the first time in a long time, we are seeing a little bit of interest in buying the VIX again. So my outlook then, I am bullish on US stocks, but very cautious right now because of that convergence of those two trend lines, the short downward trend line converging toward the long-term upward trend line. We're going to get a break one way or the other very soon, and that will telegraph the future trend. Canadian stocks, I'm neutral. I do think in the short term they bounce higher. Gold, I am neutral, but with a negative bias, and oil, I am neutral with a positive bias. Canadian stocks are still the underperformer, but are likely to move higher in the short term. US stocks remain in that bullish trend, but it is coming to a critical point where we need to be cautious. Well, that has been the Stockscores Market Minutes for June 14th, 2013. Have a great week in the market and trade well.